Today on TyNance, I will be talking you through my 10 remaining stock holdings. If you haven't seen the first part, then please click on the link in the description. For each of the positions, I will be giving you a short description of the company, my position size, my percentage gain or loss in the stock, and if I feel if it's still a buy. This is not financial advice. Please read the disclaimer in the description. Advanced Micro Devices, a company in the semiconductor space. AMD, 25 shares is my position with a total value of $2,824. The cost basis is $120 and the current price per share is $113. Currently I am down 6.2% on my position of AMD. I started buying into AMD in the past few months. Some people call this stock, instead of Advanced Micro Devices, they say AMD stands for Advanced Money Destroyer, because the stock is only going down. As you can see in the chart, it's going down for almost a year now. But since there's a bullish divergence in the fact that numbers of this company are going up, even though the stock price is going down, this could actually lead or cause the stock to go up in the future when people do finally start to value the rising fundamentals of AMD's numbers. Because of that reason, I will still be buying the stock. I don't want to make this too large of a position, but if I can add some more shares on a lower valuation and bring down my cost basis, I will definitely do so. Enphase Energy, a company that operates in the solar industry. I own 40 shares in this company with a total value of $2,557. My cost basis is $106 and the current price per share is $64. So I'm down almost 40% on this position. When the Federal Reserve, started to hike rates, and other central banks did as well, for the ECB, for example, the stock price started to go down because a lot of people finance their solar panels on debt. So they use debt to finance their solar panels, and if rates go up, and this makes it actually the debt more expensive. So it's more expensive to get a loan for solar panels. And this was clearly started to become visible in the results of Enphase, uh, which caused the fundamentals to go down and also the stock price. So I kept buying on the way down because I thought the rate cuts would come sooner, and that we would keep on cutting. But it seems that rates will be steady for a while, at least if you look at the numbers coming out right now. So since there's not a big chance that the stock will go up in the near future because there won't be any rate cuts, maybe for a year. It depends on some numbers. There's a good chance that this stock will just keep going down along the way, and because of that, since it's quite a specific sector and not really in favor in the market right now, I will be only buying more of this stock if it goes down a lot and the valuation seems really low. But for now, it's just a hold for me. ASML Holding, builder of machines that are necessary for creating chips. I own 3 shares in this company with a total value of €2,197. My cost basis is €645 and the current price per share is €732. I am up over 13% on this position because ASML is a very or a high profitable business, and it's very hard to compete with them because the machines they build are very hard to create, and until now no one is able to replicate those kind of machines in the same quality that ASML is bringing. Because this is not really a big position right now, and I have a lot of conviction in this company. I hope for it to go down back to my cost basis or near my cost basis so I can increase my position in ASML. LVMH, a global producer and distributor of luxury goods. I own 3 shares in this company with a total value of 2,139 euros. My cost basis is 600 euros and the current price is 713 euros, which means that I am up over 18% on this position. And if you look at this company, the chart, it's a European-based company from France, really. ASML, the last company I spoke about, is from the Netherlands. And Europe is down a little bit, which made me interested in these stocks. And for LVMH, I am in the same situation as with ASML, as in I hope for it to go down a bit more so I can increase this position, because I do not want to increase my position right now. The luxury market is not in a very good position right now. It's not growing that fast, and because I'm already up 18% or over 18%, I feel it's a better idea to wait for it to go down. If it does go up, great, then I make a profit anyway. But if it goes down more and I buy at a higher valuation right now, there is a risk that I increase my cost basis, and with that comes a risk I will be going down on the stock a lot sooner. So for now, it's a hold for me, and maybe I will buy more if the stock goes down. Celsius Holdings, producer of energy drinks. I own 100 shares in this company with a total value of $2,240. My cost basis is $40 and the current price per share is $22, which means I'm down 44% on this stock. Celsius Holdings has a large partnership with PepsiCo. PepsiCo distributes Celsius Holdings their energy drinks, and because PepsiCo built up inventories of their energy drinks of Celsius too much. This led to big stockpiles and too high of an inventory, which made sell-through go slower, and this stalled the revenue growth of Celsius Holdings for now. If Celsius can show that this is not a fundamental issue and the revenue growth will pick up again, I'm definitely interested in buying more of Celsius. But first, they need to show that this is not a fundamental issue to me. ELF Beauty, or ELF, is a cosmetics company. I own 30 shares in this company with a total value of $2,193. My cost basis is $96 and the current price per share is $73, which means I'm down almost 24%, which is kind of crazy because I was up over 20% just a few weeks ago. The revenue growth seems to slow down a little bit for this company, which led the stock price to fall even after the stock price was already falling due to tariffs. ELF Beauty is producing most of its products in China right now, so if Trump would impose tariffs on China, this could have some negative consequences for ELF. But I don't see any fundamental issues for this company at the moment, and I believe they will keep on growing. So because of that, I am definitely interested in lowering my cost basis per share, and I will buy some more if the stock keeps on dropping, as long as the fundamentals seem fine. Mercado Libre, a big e-commerce platform in Latin America, also referred to as the Amazon of Latin America. I own 1 share in this company with a total value of $2,110. The cost basis is $1,867. The current price is $2,110 and I'm up 13% on this position. Due to the fact that the share price of this company is above $2,000 a share and my account balance is not that high that I can buy multiple or a lot of shares in Mercado Libre due to the share price, it's hard for me to increase my position on this one. So I only want to increase my position on Mercado Libre if I can significantly decrease my cost basis. And because I'm up right now, I don't feel I have to do so. So for me, this is just a hold. Alibaba, a big Chinese commerce company. I own 16 shares in this company with a total value of $1,991. The cost basis per share is $78 and the current price per share is $124. I am up almost 60% on this stock. Alibaba is a stock and a position I held for quite some time, I believe 3 years for now. I don't necessarily want to have a large um, position in Chinese companies or a large exposure to Chinese companies because of the geopolitical risks in China. But because the valuations were so long for quite some time, Alibaba and some other Chinese companies were really attractive. And since the US market was only rising in valuation, it doesn't seem fair that the Chinese market, with all its potential and the potential of the Chinese economy, would never start growing again, and that companies like Alibaba would not profit from this. So, since I still believe in growth in the Chinese economy, even if it could take a while. Alibaba is going up lately, which is nice to see that it's finally making some gains. And for now, I'm just holding on to my Baba as my only stock bound or related to China. SoFi Technologies is a US fintech company acting like a modern bank. I own 100 shares in this company with a total value of $1,618 and my cost basis is $6.80. The current price per share is $16, which led to a percentage gain of over 137%. I started buying SoFi only about 6 months ago, so the rise in this stock went really rapidly, and that is because of the fundamentals of SoFi, the revenue, the profitability. It's all rising and all seems to go in the right direction. And it took a while before SoFi was valued through its fundamentals or growth, and now that it finally does seem to go up, I would gladly have bought more of the stock when it was around $7, but since it went up so much and so fast, just after I started buying into SoFi, I am okay with my position in SoFi right now. If it becomes too small of a position and I still like the valuation, then maybe I add to it. But for now, SoFi is just a hold. Fubo TV, a sports streaming service. I own 300 shares with a total value of $1,224. My cost basis is $2 and the current price per share is over $4, which led to a percentage gain of 106%. Fubo TV is my only not profitable stock at the moment, and it's also my smallest position because of it. Fubo TV is actually making a good progress in their revenue, so they are growing revenues, and the costs or the losses of this company actually come down. So there is a good chance they will become profitable this year, and if not this year, in the next year. They also just announced a deal, a partnership with Disney. We'll have to see how that turns out and if the deal gets through. But until that time, Fubo TV is a hold for me, and I believe that with the partnership it could go up. But right now, because it's not a profitable business, I see no reason for me to increase my position, especially because I'm up over 2x in the stock right now. That's it for today. Please like, please subscribe, and thank you for watching.